Hi to everyone. In this video, I will talk about uh, one of the quant trading strategies called betting against beta. Beta is a statistical metric which measures how a particular stock is risky in comparison to the entire market. So beta with a stock with a beta of one is riskier than the market, and a stock with a with a beta lower than one is less risky than the market. So the idea behind the strategy behind betting against beta is that the more riskier stocks, those stocks with the beta of higher than one, they will deliver lower returns in the future, and those stocks equities with the beta of lower than one, they will deliver higher returns. They will outperform riskier returns. So I decided to test the idea, and this is my attempt to backtest as a strategy on the historical data. Let's go through the code. First, we import all required libraries. Then we get our data from Yahoo Finance, and also we get risk-free data, which will be used in calculating Sharpe ratio. By the way, this function is its name is self-explanatory. I think calculates stock beta. It just calculates beta. Beta, as I told, is a statistical metric. To calculate it, we regress stocks returns on the market's returns, and we get a number which, if lower than one, implies that that stock is less risky than the market, and otherwise it's more riskier than the market. These are helper functions which just will help in our main strategy. By the way, I will put a link to GitHub where you can you can view and also download the code and play with it as you wish. So you can go through it yourself. These are some parameters that we will need in our strategy: data format, commission. To backtest it realistically, I also included a commission of 5 pp, no basis points. So after we got all our first these are tickers. By the way, this model is built on S&P 5 tickers, and we got as you see here YF download. That is Yahoo Finance download. We download all our historical data starting from 99 to 24. And then we also do the same thing for market data, which is as you see S&P 5 index. And then we go through all data. Since our data is very large, it is 25 years of historical data for more than for about 500 stocks. So that's a lot of data. We process it through via parallel processing, and that's it. And we got historical returns. By the way, here I stored the results as you see. Actually, this is a very historical, very profitable strategy. It delivers about 25 percent, but maximum drawdown is high, very high, 84. I don't think that without any modification, it would be sensible to trade this strategy as it is. And you can see its historical performance about when COVID broke out. There were a sharp drawdown here, as you see. And by the way, how let's talk about a strategy. How do we select our stocks? So first, we look at the previous 1 year data. For example, let's say we are on the 1st January of 2005. So we look at the historical data which starts from 2004 and ends on 2000, 2004 31st December. So that's exactly 1 year data. We go through all the stocks in S&P 500 index on that time, and we calculate betas for all 500 stocks. Then we select five stocks with the lowest beta, and we go long them. Go long just means in traders jargon to buy them, and we leverage them to the beta of one, because you remember that these are the stocks which have beta less than one. So we leverage them to the beta of one, and then we select five stocks with the highest betas, and we go short them, or we short sell them, and we deleverage them, which means we decrease their leverage to the beta of one. As you recall, these are the most riskiest stocks, with sometimes with the betas of significantly higher, far higher than one. So we decrease their leverage, their risk to the beta of one, and that's it. And then we do this for all month, between this over this 25 years, and that's our strategy. As you see, it delivers significantly high returns, but with very significant risk. So you can, of course, play with the code, and also maybe you will come a better idea how you can improve this strategy, how you can lower its risk. Thank you. Good luck, and thank you for watching my video.